All right, everyone. This is the Worcester Fund webinar. Now, before I get started, I want to remind you that this is a private offering available only to accredited investors. Now, for those of you I haven't met, I'm Jesse Worcester, co-founder and partner of Worcester Investments. And before we jump into the fund, I'm going to share with you a brief, shortened version of our story, the story of Worcester Investments. So we grew up in Eugene, Oregon, right on the campus of the University of Oregon, and we're still huge Duck fans to this day. We were lower middle class, and that's even probably a little generous. Did a lot of shopping at Goodwill and garage sales. Our father was a pastor of a small church, and our mother a third grade school teacher. And our upbringing was focused really on three primary areas. Number one was values, the values that our parents not only taught us, but emulated for us all throughout their lives. And many of those are key elements of our mission and core values today as a company. Number two is hard work. This is Joel and I painting on our woodshed in our backyard. And this was a typical day in the life for us. We were the kids who always had daily chores, projects around the house, worked under the table jobs as early as elementary school. And hard work was just ingrained in us from a very young age. And then number three is sports. We played all different sports, and oftentimes on the same teams as my brothers and I are very close in age. And we were obsessive. Day or night, rain or shine, we were going 150%. This is actually us in our front yard, having a great time and also dashing our father's dreams of having a nice lawn, or even a lawn at all for that matter. But this obsession, this love of sports led us into basketball as our primary sport. Joel and I played together on the same AAU traveling team in middle school. We played together in high school and then even played together in college as well. Now, we didn't realize it at the time, but these many years of sports and basketball together were laying an essential foundation. I often say basketball was really the unofficial start of our business. We had shared goals, a shared passion, developed teamwork and communication, and really learned how to work well together while chasing big goals. And we were also very entrepreneurial. So after school, knew we wanted to go into business, and it was a natural fit to do that together. And in 2006, we started Worcester Investments. Now, by middle of 2007, we had decided to move our business to Kansas City and build it there. We really saw Kansas City as an ideal market for the specific type of real estate we were seeking, which was cash flowing multifamily real estate. We started out buying small unit properties just like this one, and in the early days performed every aspect of the business ourselves. It was not pretty at all at times. We acquired 50 smaller properties totaling 150 units over the next roughly 2 years. But in 2009, we had a very significant paradigm shift when we started buying larger unit properties just like this, the City View Lofts. We realized we could not only achieve much better economies of scale on a 100+ unit property, for example, but we could also hire full-time property management professionals and focus our time on things such as strategy, investment decisions, and finding and empowering great people to improve and grow the organization. And that's the model we've maintained through today. So looking at a timeline, 2007, moved to Kansas City. 2009, switched to large multifamily. By 2014, we'd surpassed 3,000 apartment units. 2015, we start Worcester Financial, our private lending business unit, which we're going to talk a lot about in this webinar. 2017, we co-found Hawaiian Bros, the restaurant concept, which has been a tremendous success. And 2018, we start the Worcester Fund. As of today, we've acquired a little over 5,000 apartment units, and we've then sold a number of those properties as the market was inflating roughly between 2016 and 2022. Our current portfolio of what we own and operate is a little over 3,000 apartment units, and those are all within a couple 100-mile radius of Kansas City. We have a vertically integrated structure where we operate everything in-house to maximize returns for investors and for the properties. And we also have a phenomenal team. That is probably the thing we're most proud of, is our team, and that is currently at a little over 100 team members within Worcester Investments. Now, over the years, we, along with our investors, have experienced some of the drawbacks of doing one-off syndications, one deal at a time. And the fund structure we were able to create addresses a lot of those drawbacks, which is why we started the Worcester Fund in the first place. And the fund, of course, is the focus of this webinar. So let's go ahead and start with a brief overview of the Worcester Fund. Now, I think it's valuable to begin by giving a broad strokes version of how it is we see the fund. So we believe the Worcester Fund is really the best fund investment vehicle there is, not just within our own offerings, but out of anything we've seen in any other platform with any other sponsor. And I know that that is a bold claim. And so my goal for this webinar is to simply and transparently walk you through every aspect of the fund and, of course, let you be the judge of that. So we'll walk through each element of the fund, how it compares to other funds as well, and ultimately really get to the heart of what I think is the highlight of the Worcester Fund, which is the alignment between Worcester Investments and the investors in the fund, the alignment of interests. So my hope is that you leave this webinar with an exhaustive understanding of the Worcester Fund and all of its benefits, and that you see it ultimately as the first and primary option through which to invest with Worcester. And given how favorably we've structured it for investors, we anticipate that this will be the case for a lot of investors and that more of our offerings will go primarily or even entirely through the fund without the option to invest direct. Okay, well, let's start with the agenda and what exactly we'll be covering in this webinar. So number one, what is the Worcester Fund? How is the fund performing currently and historically? How is the fund structured? How does it compare to other funds? How is it that we can charge zero fees? What is the investment process? And then we'll hit some Q&A where we address some miscellaneous items. Let's go ahead and start with what is the Worcester Fund. So the Worcester Fund is first and foremost an investment vehicle that Worcester manages where investors are able to pool their money together and invest alongside Worcester Investments in opportunities that would largely be unavailable for an individual investor. There are closed-ended funds which have a limited lifespan and window to invest, and then open-ended or evergreen funds, and ours is an open-ended evergreen fund. And given our investment philosophy, we think it is a much better structure. Basically, we're not forced to liquidate assets based on certain time restrictions, and it allows us to make decisions based on what we feel is best for each individual asset and the fund as a whole, as well as our investors. And then third item is the fund invests in primarily multifamily real estate, as well as real estate-backed private loans, which really provides for a great balance between risk, return, tax benefits, and diversification. Let's go ahead and take a look at a visual representation. So on the top here, we have investors who are invested into the Worcester Fund. And it's a little hard to see here, but Worcester Investments is also an investor in the fund. And then the fund invests primarily in private loans, which are also known as hard money lending, as well as multifamily, which I will use synonymously with equity investments. And one important note is that the fund is designed to invest in cash flowing investments. We distribute monthly, 5% annualized. And so the fund is not designed to be overly speculative. So these loans down here, as well as these equity opportunities, they are designed to contribute monthly distributions that go to the fund, and then the fund then distributes to the investors. In terms of size, the fund is a little over 12 million as of the recording of this webinar, which is Q2 2023, and we'll break down the specifics of that 12 million a little bit later. Now let's look at some of the advantages of investing in the Worcester Fund. So number one, the fund is investable at any time, and that's in contrast to equity opportunities, syndicated equity opportunities, for example, which can be few and far between depending on the state of the market. Number two, zero management fees, and I have a dedicated section walking you through how exactly that works, how we're able to charge zero management fees. You also have instant diversification when investing in the fund, as well as a diversified investment strategy between longer-term equity investments as well as short-term private loans. We have consistent monthly distributions, 5% annualized. You have liquidity options, which are not found in traditional real estate investments, tax advantages through real estate ownership, and then also distribution reinvestment options where you can get a compounding return, which I'll give an example of later on. So first of all, how is the fund performing currently as well as historically? So the fund is performing very well. Let's go ahead and take a look at a graph here. So this graph highlights the average realized returns that we have received since the inception of the fund. And obviously we have a great last couple of years here and a great trajectory. And this is the actual distribution paid out on the initial investment for each investor. It's important to note that there are two ways you make money as an investor in the fund: cash flow and then asset appreciation. This return is 100% just from cash flow and not taking into account the asset appreciation. And the asset appreciation is quite significant. So the average annual total return, including unrealized return, is over 14%. And let's go ahead and take a look at an example of what I mean by that. All right, so we're talking about these equity investments here, and I'll just use one example to illustrate equity appreciation. So we bought one property completely within the fund called Oak Tree Square. We bought it for somewhere around 60 cents on the dollar, so we had immediate equity going in. We also made some improvements to the property over a couple years and ultimately sold that. And anytime we reach a significant milestone on an equity investment, we will increase the value of that property within the fund, which in turn increases the price per share of the fund. So similar to a stock investment, when it goes up in value, you have unrealized return, meaning you don't realize that return until you actually exit the investment. And so that, in a nutshell, is asset appreciation, where these equity investments are going up in value, creating an unrealized return. And now let's take a look at how the fund is structured. So we are roughly 40% in equity, 56% in private loans, and then a little under 4% in cash. And one thing to kind of highlight in terms of how the fund is structured is flexibility, really just the ability to adjust to the current market conditions. When there's less equity opportunities, as there have been in the last few years, we are going to have a higher concentration of private loans as we do now. But if the market shifts, as I believe it will, and there's more good buying opportunities, we can take loans that are paying off and invest that capital into new equity opportunities, or prioritize new investments in the fund into those equity opportunities. And you'll see this balance, this ratio between equity and private loans, you'll see that balance shift. So instead of trying to time the market between short-term loans and long-term equity investments on an individual basis, an investor can get the best of both worlds because of the fund's flexibility. In terms of equity investments, for the sake of time, I'm not going to go deep on each individual investment. I want to roll through these to give you an understanding of the types of equity investments in the fund, and our team can provide you as much detail as you'd like on any of these individually. So this first one is a mobile home park here in Kansas City. Belton is a submarket of Kansas City, and this has really been an absolute cash cow, a phenomenal investment. These are two QSR retail investments, strong, reliable, cash-flowing properties, and we also have significant equity in these due to the strength, the growth of the Hawaiian Bros brand, and the value of these long-term leases. These are two apartment communities. Both have been great deals, especially Lakeview Crossing here. We invested over $1 million, I think it was $1.2 million in this deal, and it's really been a home run. We have two more apartment communities here, and apartment communities in general are going to typically have lower returns in the earlier years, and these are two of our more recent acquisitions. And that's as we're completing any repositioning or improvements on the property, and then you typically see higher returns in the later years after a refi maybe, and then especially after a sale. So now let's take a look at the private lending side of the fund, and that is through Worcester Financial. So Worcester Financial was launched in early 2015 as a completely independent private lending company with the focus of doing hard money loans on rental real estate in the greater Kansas City area. Since then, Worcester Financial has originated over 130 hard money loans totaling just about $110 million. Now, given Worcester Investments' expertise in the multifamily space in Kansas City, the addition of private lending was a natural transition in order to add attractive options for placing both Worcester Investments and its investors' capital. Worcester Financial takes the simple approach of asking, would we be happy to own this asset if we had to take it back from the borrower? That, of course, being the worst case scenario. And with our experience and existing property management in place and already successfully operating in the market, we are in the very unique position of being able to take back and operate an asset in that worst case scenario situation, whereas a bank or most other private lenders are not in that position. Pairing that with our experience as an active investor in the market as well, we feel it gives us a very significant advantage over any competitors. The fund then invests in some of the private loans that Worcester Financial puts together. So the fund actually has first right of refusal to any Worcester Financial private loans, so it's able to invest as it needs to, as it desires to. So currently, the fund has 17 private loans it's invested in, an average interest rate of right at 14% currently, average loan size of over $400,000. Typical average loan terms are going to be 12 to 18 months. Our average real estate LTV is under 70%, which we really like, and we've had 0 missed payments to the fund. A few other notables is Worcester Financial will charge anywhere from 11 to 16% to the borrower, usually a 2 to 4% origination fee. Worcester Financial will typically take a 1, sometimes as high as a 2% servicing fee, and then pass the rest of the interest on to the fund. Okay, so how does the Worcester Fund compare to other funds out there? Now, there are a lot of funds with a lot of different structures and investment focuses, so I'm not going to go into detail on all the various differences out there. But what really stands out, what really makes the Worcester Fund truly unique, and we know of nobody else who offers this, is the fact that we actually have 0 management fee. And it really aligns our interests with our investors, in my opinion, more than any other fund out there. And so this 0 fee structure is really significant. So let's jump into it. You see, with a typical fund, the returns are generated from the various investments. And the first thing that happens when those returns are generated, the first thing that gets paid and prioritized is the management fee. It dilutes the return for the investors, and it prioritizes the fund manager over the investors. The fund manager gets paid regardless of how the fund performs. In fact, fees and this structure, this typical structure you see here, are often one of the biggest complaints about a fund. It's seen as a trade-off. You have to pay these fees in order to get all of the benefits of a fund, such as diversification, liquidity options, etc. Only with the Worcester Fund, you get the best of both worlds. No fee, and yet you still get all of the fund benefits. And what excites me is the fact that this goes straight to the investors' pockets and really aligns us 100% with our investors. So this naturally leads to the question, how is it that we can charge 0 management fees? Let's go ahead and look at a diagram to see how this works. So the simple answer is that with most funds, the fund manager acts as a middleman between the investors and the sponsors or operators who are actually putting together each deal. So there really is no other way for them to get compensated, and the management fee is necessary with this structure. With the Worcester Fund, though, we are the sponsor. We are the one putting together each deal, so we don't need to get compensated as a middleman. We're happy operating the fund at no cost and simply participating in each deal as the sponsor, as we always have, and then also as an investor in the fund and the fund manager. So the question is, if we're not taking a management fee, how is it exactly that Worcester makes money. So we participate in two ways. First of all, we are an investor in the fund ourselves. As I mentioned before, we participate right alongside you as an investor in the fund. And then secondly, we participate as the fund manager in a very similar fashion as a sponsor would in a typical deal. So we participate in the post-pref split, meaning, and I'm going to zero in here, this is hard to read, the first 8% goes to the investor. That is the preferred return. And then anything above and beyond that 8%, we are participating in a certain percentage of that. So using the example of someone who has invested $1 million in the fund, 70% of that post-pref split is going to the investor and 30% is going to us as the fund manager. And that really creates a 100% performance-based model, meaning we're only getting paid to the degree that we're doing well for you, the investor. Okay, so next we're going to look at what is the investment process. So the investment process occurs really in three phases. So when someone first invests, the money goes into what's called the holding account. This is accepted on a first-come, first-served basis. The money will wait here for the next available opportunity the fund finds, and we really try to not keep the money waiting in the holding account too long. Once the fund has an investment opportunity available, the money is moved to the operating account and then deployed. And what happens here is as soon as the money is moved to the operating account, from that date through the end of the quarter, you, the investor, gets paid a flat 8% return in the form of a loan. Then on the first day of the following quarter, the money is fully subscribed into the fund where you receive the 8% preferred return, the post-pref split, and you are a fully subscribed member of the fund. Using an example real quick, let's say you were to invest on February 15th, and let's say there are a few people in front of you, so the money sits for 2 weeks. You receive no return during that time. Then on March 1st, the fund is able to transfer your money to the operating account and it deploys it. And so for the remainder of March through the end of the quarter, you receive that 8% flat return. And then on April 1st, you are fully subscribed into the fund. Okay, let's go ahead and take a look at the investment classes. Okay, so we'll start on the bottom here. Class D. So this is anything from the minimum investment of $50,000 up to, technically it's $249,000 invested. And that is the 8% preferred return, and then the split above and beyond that is 50% to the investor, 50% to the sponsor. Class C is between $250,000 and $499,000. That's a 60-40 split. Class B is $500K to $999,000. That's a 65-35 split. And then Class A, anything over a million or over, is a 70-30 split. And one important note here, and I don't think I've mentioned this yet, is that these amounts are cumulative. So this is the total amount over time that you've invested in the fund. And that's a great way that this creates an economies of scale impact, is even though you may not have the full amount all at once to get into the class that you're wanting to get into, you can build up to that over time. And that's a significant difference between a fund example like this and investing into individual deals one at a time. Okay, so the first question we have in our Q&A is, what is the distribution reinvestment option? And I've got a visual here. So ultimately what this is it's an opportunity to, instead of receiving your monthly and quarterly distributions, you choose to have them automatically reinvested back into the fund. And what it does is it creates a compounding return effect. And so I've just got a hypothetical scenario here. On the right, we have the hypothetical scenario of just receiving a 10% cash-on-cash return, and you're receiving the distributions over a 10-year period. Your average cash-on-cash return stays at 10%. And in the scenario of the compounding, where you are reinvesting those distributions each month and each quarter. What it does is it creates ultimately over a 10-year period a 16.1 cash on cash return because, as you can see here, your account balance is growing over time, whereas it's not in the scenario on the right side. So really, really powerful and definitely a facet, a feature that simply does not exist in real estate. There's no way to reinvest distributions in a traditional real estate investment. Okay, so the next question in the Q&A is, what are unit redemption options? So the unit redemption option is the feature that gives you liquidity not found in typical real estate investments. This is the option to sell your shares in the fund, much like you would with any stock, yet because it's not a publicly traded offering, what actually occurs is the fund buys back your shares. Now, there is a 4-year lockout where this option is not available, but after that, it's available at any time. And we do the lockout because we're making a number of longer-term investments in the fund, and so it's necessary to have some period of time where a person is not able to redeem their shares yet. Now, one neat thing is that even though you own shares in the fund and are technically not a direct owner in the real estate in the fund, you still get the depreciation from the fund assets. So you get the flexibility of owning a stock along with the tax benefits of owning real estate. All right, so the next question on the Q&A is, does the 4-year lockout renew for another 4 years after the initial term? And the answer is no. So you can liquidate a portion or all of your fund position at any point after the initial 4 years. Next question, is the fund audited? And the answer is yes. Next question, can the fund accept IRA funds? And the answer is yes. So our team can help work with you on those details. Just as a quick recap before we close this out, we'll cover each of the fund advantages or features from this page. So number 1, investable at any time. Number 2, 0 management fees. That's probably the feature I'm most excited about, where it really aligns our interests and creates a true performance-based model. Number 3, instant diversification as well as a diversified investment strategy. Number 4, consistent monthly distributions. So that's a 5% annualized monthly distribution and then a quarterly true-up. Number 5, liquidity options. So relative to a traditional real estate investment where there's really no liquidity, that's a feature we have here. Tax advantages through real estate ownership, number 6, and then the distribution reinvestment options where you have the compound return or compounding return effect as number 7. All right, well, that is everything. Thank you so much for watching. As a final note, if there are any additional questions that you have, you can always connect with our team to have them walk you through those. Have a good day.